So first of all, I want to make sure you're all doing what you need to try to stay safe tonight, and over the next couple of days. This recording should not necessarily be a huge priority right now, but I want it there. So if you have some time and you can safely watch it, that you can do that. To try to keep us on track where we can keep our exam review session at the end of the uh, content unit, I want to make sure we stay somewhat on track. So I'm going to be starting here with the PowerPoint on chapter 2, and then I'll be posting a workout sheet that has some sample problems along with the posted solutions to that, and then an Excel file that has the journal entry summary in the Moodle page for y'all. So if you have any questions about any of that, feel free to reach out to me, and weather permitting and technology permitting, I will get back with you as soon as I can. So I hope you're all staying safe, and I hope this video finds you well. With all that said, we're going to go ahead. We're going to get into the video and into chapter 2. So I'm not sure why the screen is showing like this, so we're going to do this so that hopefully it looks a little bit nicer for you. Okay, so here in this chapter, we're going to be primarily talking about what's called job order costing. So this is closely related to another topic called process costing. And job order costing generally is useful when we have things that are unique or different. Alternatively, process costing is useful when you have a bunch of units of something being made that are all basically the same. So imagine you're making like some type of ice cream and you're making the same flavor over and over and over. Well, process costing might be useful there. Alternatively, job order costing is really helpful when the thing you're making is different and unique. So if I'm a home builder and I'm building custom homes for people, or if I'm a jeweler and I'm making unique jewelry. So you can see there are times when it might make sense to try to mass produce something. You could also say maybe you're doing tennis balls. Well, if all those tennis balls are the same, I don't necessarily care which individual tennis ball I'm dealing with. I just care that it's a tennis ball of this color, this size, whatever, and I have some type of costing for that. Alternatively, for the more unique things, we want to use job order costing so that if I'm building my own house and you're building your house, you don't get charged for the stuff in my house and I don't get charged for the stuff in your house because maybe we have different tastes and preferences. And so that's what this chapter really focuses on, is it will briefly talk about both and then kind of move over to really focusing on job order costing. And it will also be talking at extensive length about this idea of overhead. So we'll look at how to apply overhead. We'll look at how to estimate overhead. We'll look at what happens if we have overhead over applied and under applied. We'll look at some journal entries in this chapter. Keeping with what I told you on the first day of class, there are not a ton of journal entries in this class overall, but this chapter does have the bulk, if not all of the journal entries for the entire semester. So do expect a few of those as we kind of move through, but it shouldn't be anything too crazy, especially if you are somewhat comfortable with the journal entries from financial accounting or from accounting 1. So hopefully that helps out. Okay, so here with the first learning objective, we're going to look at cost systems and the flow of costs in a job order system. So as we talked in class before, we have this idea of cost accounting, or what we call management accounting in this course, which has 3 main jobs. We want to measure, record, and report. And as I briefly discussed before, we do have 2 types. So this makes a great multiple choice question on an exam. What are the types of costing systems that we have? When might they be used? How do they differ? How are they the same? Things like that. So kind of as we cover this chapter, I want you to keep that in the back of your mind, that you're thinking, well, when would I use a process costing system? When would I use a job order costing system? Now, here at LSU, we really focus on the job order costing. If you are extremely interested in this stuff, or if you think you're an accounting major and you're going to have to really get into this in the later accounting courses, then I would recommend you go over to my YouTube channel, where I actually have a full video on specifically process costing, and I cover the kind of nitty gritty stuff there. But in this video, all you need to know for this class, all you really need to know is that process costing exists, and we use it when we're mass producing a similar product. And alternatively, job order costing, what we're going to be really focused on is when we have unique issues and each individual product has its own nuance. And so we want to be able to capture that in our costing. So that's that. Let's go ahead and move on to the next slide. So we'll go ahead, we'll trash those drawings, and now we'll look at here. So once again, process costing used when there's a large volume of similar products. So this could be cereal, petroleum refining, ice cream, tennis balls, anything like that. Costs will be accumulated typically for about a month or a week, and then they will be assigned widely across everything that was involved in that process. So you can see how this would be a lot easier for us to do. And when I've got 100,000 tennis balls, maybe it doesn't make sense to price each individual tennis ball, but I can price the 100,000 and say, well, how much felt did I use? How much cord did I use? How much, material or dye or whatever I used? And I can allocate that across everything easily. And that will make my life so much simpler, and it will make our costs a little bit lower. So that's very nice. The next thing we want to look at is kind of an example of this. So you can see here, if we are looking at potato chip production, and there's a couple of steps here. They outline 5 steps. First, you have to harvest the potatoes. I would argue, there's maybe some steps before that even. So you've got to plant, you've got to maybe fertilize and water, you've got to harvest eventually, you got to clean them up, you got to slice them, fry them, and bag them. Well, then you've still got to label them. You've got to, ship them out to a customer who's going to sell those for you, or maybe you're selling them directly wholesale. So you've got a lot of steps in these things, but this is the portion that we're focusing on here with this potato chip production. So alternatively, we've got what's called a job order system. These are assigned to each job or to each batch individually. And this is because the job or the batch has its own characteristics that make it unique and different from the other products. And so that's something we want to keep an eye on. Here, you're going to be trying to compute the total cost per job. Typically, this is going to have several components. So these are not unfamiliar components. If you have already watched the chapter 1 content, this would be things like direct materials and indirect materials, direct labor and indirect labor, and then manufacturing overhead. And so those are the things that we're going to be primarily following here. So here's a basic example of how we would record something in a job order cost system. And so you can see on the left, we've got for computer programmers, musical composers, voiceover talent, and animation talent. So this might be the people or the objects that we're dealing with, the jobs that we're dealing with to create an animated film. And so when I use the word object here, I'm referring to what's called a cost object, which is the thing that we're assigning cost to. So in this case, if you're doing the programming, then maybe we would say the programmers are a portion of the overall cost object, which is the animated film production. And so we could say that, and that's kind of what that terminology would mean. You could see alternatively for a different type of project what that might look like on the right. Next, we'll see here that we see the flows of costs, and they will parallel or they travel in tandem or at the same time with the physical flow of goods as they are converted into finished goods and then eventually sold. And so we looked at this process in chapter 1, both on the board and when we pulled up the financial statements. I believe we did Walmart and Abbott Pharmaceutical, and we saw that Abbott actually had their inventory broken out among different categories like is being described here. Whereas Walmart, who's a retailer and only sells finished goods, only had one account, and it was just lumped together called inventory. And that's because Walmart only sells finished goods. So they don't care where things are in the process. They don't have anything else in the process. But Abbott, who does their own production, well, for them, they need to know, well, is this still just a raw material? Is it actually entered into production? Is it finished? And then if it is finished, can we sell it? And then, of course, it would move to cost of goods sold. And so that's really important for us to think about. So in this case, we'll say the cost of jobs that is completed will then be transferred to the finished goods inventory account. And so you'll recall from class on last Monday where we talked and we said, well, we've got the 3 T accounts. We've got raw materials inventory. And I told you, if you were drawing this, of course, you need to keep that I. So you remember, so inventory account. Then you've got work in process inventory. So that'll be this middle T account or the second T account. And then, of course, that will transition over to finished goods inventory when things are done. Remember, these are all inventory accounts, and because they're all inventory accounts, these are all assets, which means they all have a debit normal balance. So these are your asset accounts that we're dealing with. That means they all increase with a debit and decrease with a credit. That's why the rule here is we debit where we're going to, and we credit where we're coming from. Now, once the thing is finished and we actually sell it, of course, at that point, it will transition over to cost of goods sold. And we will move from having an asset, which of course is reported on the balance sheet, to what is called cost of goods sold, which is an expense, which goes on the income statement. So this will be an expense, and this will, of course, go to the income statement. So that has a normal balance, once again, of a debit, which means a credit would make it go down. Similarly with all of our inventory accounts. So once again, the rule holds where once I sell something, I would debit cost of goods sold and make that go up. And I would credit finished goods inventory and make that go down. So once again, debit where you're going to, credit where you're coming from. If you'll keep that rule in mind as you work through the journal entries in this chapter regarding inventory, it will save you a lot of headache and a lot of mistakes that I see students make often, where they start getting the accounts backwards or they start doing something funny. So just keep that in mind. This is the flow of inventory throughout the process, and you debit where you're going to and you credit where you're coming from. And so with that, we'll go ahead, we'll move on to the next slide. So once again, when units are sold, they go to cost of goods sold. So here's a physical kind of picture form of what we were just talking about. So you can see there are some manufacturing costs here, things like materials, labor, and overhead. So that should not be surprising, because last week when we talked about the manufacturing cost equation, we said total manufacturing cost is equal to direct materials plus direct labor plus applied factory overhead. And we'll get into that distinction between actual overhead and applied overhead a little bit more in this chapter, and then of course throughout the rest of the semester. So we see that kind of working its way through in this example. So in this case, they tell us we've got Wallace Company who purchases on account some batteries at $5 a unit. They tell us, well, that's 2,000 batteries at $5 a unit, it's $10,000. And 800 electronic modules at $40 a unit for a total of $32,000 for just those modules, which means the total cost of 32 plus 10 is $42,000. And they want us to record that journal entry. And so you can see here, these are raw materials that we've got. We're going to debit raw materials inventory. Now, I strongly encourage you write all of your journal entries by hand on paper, and I encourage you to write arrows when necessary to remind yourself what is happening to that account balance, because it will make more sense to you both in the moment and when you go back later, so that you kind of tell the story of the journal entry to yourself. A lot of times I see students just jot journal entries down really fast, but they don't give themselves time to really think through what they're writing. And they'll come to my office and we'll look at it and they'll go, oh my goodness, I can't believe I did blah. But had they taken the time to kind of tell the story to themselves and draw those arrows, they might have caught the mistake before they ever turned it in. And so I strongly encourage you, like in this example, we purchased inventory. And so we know the inventory account, which is an asset, should be going up. So that's a debit. And we know that the accounts payable is a liability account. And so it goes up with a credit. And so when I look at this journal entry, that makes sense to me. That's what happened. And of course, we see the key words here on account. If they told me we purchased this with cash, of course, then I would just be crediting cash here. But as it is, for the accounting equation to hold, here we had an asset go up and a liability go up. So the overall accounting equation remains in balance. So very good. So hopefully that kind of brief review of how journal entries work from financial will be enough to kind of get the ball rolling again here for you. Now, once again, they're going to really start to dig into labor costs in this chapter a little bit. This is fine for something like a multiple choice question, like what are the things that are maybe considered in factory labor? I'm going to tell you we generally don't get that nitpicky for the actual journal entries. So know this, because it could pop up as a multiple choice question. All the following are included in, payroll costs except or something to that effect. But this is not a slide that I'm going to break out separately very often in journal entries. So just keep that in mind as you kind of study for the test and you approach the homework. So in this case, they tell us Wallace has $32,000 of factory labor costs, and they want us to record the entry. So they say the entry to record this is what? So here we will debit factory labor for $32,000, and we'll credit something like payroll liabilities. Or you say in financial, you might have called this wages payable. So that's kind of what this is. Once again, in this case, you've got factory labor. That's going up with a debit. It's effectively an expense. And you got payroll liabilities going up because these have not been paid yet. So this is a liability. It's an incurred thing but we haven't paid it out yet. But remember, we've got that matching principle from financial that tells us we record liabilities or we record expenses when they are incurred, and we record revenue when it is earned. So in this case, we have to put the expense in the same period as the revenue it helped me generate. So even though I have not paid the cash for the labor yet, I still have to record that now, right? Otherwise, we'd have companies playing all kinds of funny games at the end of the year, deferring payments and bumping up income and then playing all this weird game at the end. And they still try that occasionally. And that's kind of why we have the auditors there and why we have hopefully a robust system of internal controls to prevent any shenanigans. But this is the setup, right? This is the way that we approach this. So hopefully that kind of helps there. Okay, we'll go ahead and move on to the next slide. When we talk about overhead, of course, there's many types. We've got things like property taxes, depreciation, insurance, repairs. All of that is true. But remember, when we talk even about overhead, we have to be careful about what we're considering overhead. So if we see something like property taxes, that may be manufacturing overhead, or it may not be. If we see depreciation, that may be manufacturing overhead, or it may not be, because remember, it depends what they're in relation to. So if we see property taxes on the factory, well, that's manufacturing overhead because that's used in the production process. If we see depreciation on the factory equipment, that's going to be manufacturing overhead. But if I saw those things for the office or for the selling, the sales department, the selling department, well, those things would not be manufacturing overhead because at that point they would not be involved in the production of the inventory. So you do have to be careful. So a lot of times students see things like depreciation, they instantly throw it into manufacturing overhead, but I caution you, remember, if it is related to production, then we have to do that. If not, we have to be more careful and expense it as a period expense. So do keep that in mind. Next, in this case, they're going to give us a sample journal entry here. So we see we've got utilities payable, insurance, accounts payable, accumulated depreciation, property taxes. We're assuming in this case, all of these are in relation to the manufacturing facility. And so you'll notice these are actual things that actually happened. And so we're debiting manufacturing overhead. So this is the first time we're really going to talk about the manufacturing overhead T account in some more detail or some more depth. And so right now we're going to look here at manufacturing overhead. So that's just going to be MOH. And what I'm going to tell you is if you put something on the left-hand side, that is telling me that this is actual overhead. And if you put it on the right, this is applied factory overhead. And so what that means is anytime you do a journal entry, if you debit manufacturing overhead or factory overhead, then you're saying this actually happened. We know it. It's a real thing. Here it is. And if you put it on the right-hand side, you're saying essentially this is an estimate. This is our guess, our best estimate of what we think is either going to happen or what may have happened. And then we'll have to actually correct that at the end. And so if we get to the end of the period and actual, so the debits are greater than the credits and what we have applied, then we will say that we under applied. So we didn't apply enough. And if on the other hand, we end up with more credits, then this will be over applied. And we'll say, well, we applied too much, right? We didn't need to apply that much. And then we'll have to deal with that. We'll have to correct that later. And so that's what we want to notice right here. So I'm going to try to clean this up just a little bit. We'll see how this works. It's going to look pretty ugly, I think, but hopefully try to limit some confusion here. So we can see if you have an ending balance on the left, you are under applied. And if you have an ending balance on the right, you are over applied. Now, those same relationships hold for saying that these things are going to affect your costs as well. So do keep that in mind. Do keep that in mind. Okay, so with that, we're done with this slide. And we can move on. So here they tell us we've got a company, they incur the following costs. They've got raw material purchases of $4,200 on account. They've got factory labor of $18,000, factory utilities of $2,200. Notice are payable. Prepaid factory insurance of $1,800 has expired. Some has already been used. And depreciation, and notice here the important word on the factory building is $3,500. So hopefully that will help you there. So in this case, we'll go ahead and hopefully when you see that word factory, it tells you what this is. Because if that had said office building, then of course that'd be a period expense would go to the income statement right now in the current period. But because it's related to production, it actually gets included in the inventory account through manufacturing overhead. So do keep an eye on that. Okay, so first of all, we want to record this journal entry. And so for the first one, we purchased some inventory on account. So of course, this is the same entry we saw earlier, debit to raw materials inventory, credit to accounts payable, just in the amount of the transaction. For the factory labor, we have a debit to factory labor, a credit to payroll liabilities for $18,000. And for the next one, we have factory utilities of $2,200 are payable, prepaid factory insurance has expired, depreciation is $35. So all these are overhead items. And so we have to go through those right here. So we have manufacturing overhead, and I actually made a mistake here in how I would normally do this. And so I apologize for that, but I'm going to go ahead and fix it right here and say this is actual manufacturing overhead. So once again, I strongly recommend anytime you write this journal entry down, if you're debiting manufacturing overhead, go ahead and include the word actual on your paper. And if you're crediting manufacturing overhead, go ahead and write the word applied. That way you remind yourself through repetition which is which, because every semester I see a barrage of students they get these backwards. And so that manufacturing overhead T account we talked about earlier, I actually have it as a pretty much a permanent sticky note on my desk in my office, and I see it every day when I come in. I generally will have it written on my board in a kind of permanent position so that I see it every time I look at my board. I don't think you can see it too often to remind yourself of how that overhead T account works. And so that's really important. So do keep that in mind. Okay. Next, we want to go ahead and we'll move on. So for the next slide here, we're moving on to learning objective number 2. So we're using a job cost sheet here to assign cost to work in process. And so here we want to look first of all to the debits made to the work in process inventory. And then of course we'll have credits made to things like raw materials, factory labor, and manufacturing overhead. So let's see how this works. We're using these job cost sheets to record costs to specific jobs, and each debit entry to work in process. Of course, we'll have a corresponding posting to multiple, or at least one job cost sheet. So I generally like illustrations like illustration 2.4, if for nothing else, than to show you what this might look like in the real world, right? Like, I think we get tied down a little bit too much to textbooks sometimes. We just start recording entries and doing things, but we don't think about the real world implications and what things would look like there. So do keep those things in mind. Okay. So there's that. So you can see here, of course, you got a job number, you got whatever your item is that you're dealing with, you've got maybe a materials requisition date, you've got the date the work is actually completed, you've got separate locations for materials, labor, and overhead. You've got the actual cost below, the total cost, you've got unit cost there. And so you see all of that. So this is what this might look like in practice. Next, we'll say the raw materials costs are assigned when the materials are issued from the materials storeroom in response to a request. Materials requisition slips are generally how this is done. It's a written authorization for us to supply those raw materials to the job. So this is the setup here. In general, these types of terminology things could show up as an individual multiple choice question, but certainly nothing more than that. And so I generally recommend students to kind of familiarize yourself with the terms to some degree here, like what a materials requisition slip is. It could be a multiple choice question, but those kinds of things tend to be a little too nitpicky for my liking. So I don't spend too much time on them on the exam. So you might get an individual question or two over some definitional thing like that. But generally, I'm going to ask you to apply the terminology or apply something with math to the setup, right? To show me that you really understand how this works. And so I'm not going to tell you it can't be there, but I would not stress too much about that type of terminology. The terminology we're really worried about are things like, as we get to it in future chapters, variable cost versus fixed cost, and how those work specifically, what it specifically is included in manufacturing overhead, what's a direct material, what's an indirect material, what's manufacturing overhead. Those are the terms that we really want to know well. Things like materials requisition slip, you might run across it, but I wouldn't spend too much time on it. So here's an example of what that might look like. I'll let you look at that on your own time. Now, here they tell us we use some direct materials, but some of them are indirect materials. And so we have to be careful in how this actually works its way through in our journal entries. So notice what this graphic is showing you. On the left-hand side, in the raw materials inventory T account, we are seeing that we had a balance of 42,000 and 30,000 came out. So the credit to raw materials inventory is for the full 30,000. But notice the debit is not entirely to work in process inventory, nor is it entirely to manufacturing overhead. But they told us 24,000 was direct materials. So that portion goes straight through to work in process inventory. But then 6,000 was indirect materials. Remember, those indirect materials, those are not work in process, those are overhead, right? So that 6,000 will go to manufacturing overhead. So the journal entry in total would be a debit for 24,000 to work in process, a debit to manufacturing overhead for 6,000. Of course, that would be actual. And then a credit to raw materials inventory for 30,000. And so we can see that right here. So once again, I recommend if you're writing this down physically, I would come in here on manufacturing overhead and I would put in just in parentheses, actual. This is actual manufacturing overhead. This is what actually happened. And once again, I think that's really important when you're learning this stuff so that you don't forget, right? So that you don't forget. So I'm going to kind of squeeze it in here, but that's the setup. So do keep that in mind so that you don't forget what is actual, what is applied. Okay, so I'm going to clear that off and we're going to go ahead and move to the next slide. So here's an example of the subsidiary ledger or the subsidiary ledger. This shows up a lot better in the text, so I'm not going to try to talk about it on here because the font and everything is a little bit too small. But I recommend you just spend a minute or two, kind of look through it in your book and move on from there. So this is a pretty decent example of what that might look like as you kind of tie things down. Next, we want to look at factory labor costs. And so generally, factory labor is one of the easier issues that we have to deal with. So these are assigned to jobs on the basis of time tickets. So this is, for example, if you've never worked in a job where your time is really tracked very well, where you'll actually have to either punch in on a punch card or maybe you write it down on a spreadsheet or something, the time that you get there, a description of what you do generally during that time, and the time that you punch out or the time that you stop working on that task. Especially if you're going into accounting. I know in public accounting, it was not uncommon for me to work on 20, 30, 40 clients in a day sometimes. And so if that's the case, you want to make sure you have a way to track exactly what you're doing for each client at each time, so that you can kind of see where things are going. So that would be my recommendation is if you get into a job like that, get really good at least making quick notes. Now, you may not fill it out in the official time software system until the end of the day or until the end of the week, depending on how you want to manage your time. But you should have some system of keeping track of it as you move. That way you don't get to the end of the day or the end of the week and go, now, where did my time go today? Because sometimes it can be pretty hard if you're bounced between a lot of things or things keep popping up and coming in and out to remember exactly where your time went. So keeping a running log of that is going to help you be more productive, help you stay more on task, and kind of help you see where your time is going. So I do recommend you get good at that, but this is an example of what that might look like. So you can see the date, you see the time in, the time out, and the hourly rate and the total cost. So this one, they don't actually have a description. In the time system I used in public accounting, there was a note field where we were expected to actually write maybe a sentence or something, prepared 10K or worked on W2 or whatever it is, so that we would know what that time was for. So In this case now, they give us a slightly different example from earlier where they tell us we have $32,000 of factory labor, 28,000 of that is direct and 4,000 is indirect. So somewhat unsurprisingly, perhaps, you see the journal entry here that's popping out. And hopefully you're starting to notice that when they tell me something is indirect, that is, of course, manufacturing overhead. And once again, in this case, this is a debit to manufacturing overhead. So this is actual manufacturing overhead. This is real. This really happened. And then our debit to work in process inventory for the direct portion, and a credit to factory labor or payroll liabilities, they called it earlier. So you'll kind of have to be careful on the exam, but as you start typing, the account list will pop up. So you'll kind of be able to tell what account they're looking for based on what is available as an answer and what's not available. So once again, you can see how this works out through the T accounts as we just discussed. So look at 2.8 in the book. The font's a little bit too small for us to see here. So in this case, we're going to go ahead and move on to the next slide. So Danielle Company is working on 2 job orders. The job cost sheets show the following. We've got direct materials for job 120 of 6,000 and job 121 of 3,600. Direct labor for job 120 is 4,000 and for job 121 is 2,000. They want 2 summary entries to record the assignment of cost to work in process from the data on the job cost sheets. So for the first job, we've got direct materials. For the direct materials, we got job 120, 6,000, job 121, 3,600. So you can see here, they combine those, the 6,000 plus the 36, and they do this. Now, I will tell you in practice, this is a very bad way to do this because now you have lost the transparency in the journal entries. So generally, you would have something like, if this was your company, you might record this as work in process inventory, job 120, and then you would have, of course, a debit for 6,000, a debit to work in process inventory, job 121, and then there you would have the 3,600. And so you might see it like this in practice to maintain that transparency so that as you're going back later and as you're doing things, you could see that a little bit more clearly. And then, of course, the credit would still just be to raw materials inventory in total. So it would look something like this. If I were instructing you on how to do this for a real company, this might be the formatting that I would tell you would be most helpful, because then you have the ability to see exactly what has happened within the journal entry. Alternatively, you could put a note at the end of the journal entry. So you could do something like, say, the 9,600 in work in process inventory is a combined amount representing $6,000 for job 120 and $3,600 for job 121. And so you could do something like that. It doesn't really matter, but you would want some way to make sure that you maintain that transparency, because otherwise, when you get to the end of the job, you're not going to know how to split it ex post, right? So in the moment, it's really important that you keep really good, really detailed records so that when you get to the end, you know where the pieces came from, because otherwise you will get to the end and not know, well, where did this 9,600 come from? How much went here? How much came there? And then you have to start backtracking. It's going to take you a lot longer to find that information, if it is even possible to be found, because sometimes you may lose track of something or something may get lost. And so having those kind of built-in checks as you go will help prevent those types of situations from occurring. So there's that. Okay, we'll go ahead and move on to the next slide. So you can see that. And then for the direct labor, once again, they're going to go ahead and lump them together. Similar to my last recommendation, I would say you probably want to have that split out so that you know what happened there. Okay. Next, we're going to be looking at determining and using the predetermined overhead rate. So there are a couple of formulas in this class that I think are absolutely crucial to you having a chance to be successful in this class. The total manufacturing cost formula, direct materials plus direct labor plus applied manufacturing overhead, that's one of them. All right, that's kind of our accounting equation, if you will, from financial, where we had assets equals liabilities plus equity. The manufacturing cost equation itself is kind of that foundational for this class. The second most important formula in this class is likely the predetermined overhead rate formula, because it gets used not only in chapter 2, but in every chapter from here to the end of the text. And so you really want to make sure you understand how overhead works. And while we will talk about it and discuss it many, many, many times over the course of the semester, it is not at all unusual for students to mess up this computation that we're about to discuss. And so I want to make sure you kind of understand going in that this is a very important process and that it will cost you a lot of points throughout the semester if you don't kind of get it now. So really focus in here for the next minute or two on what we're about to talk about. So when we talk about predetermined overhead rate, it has two pieces to it. The first piece, the numerator, is what we call the expected cost or the total expected amount that you are going to be dealing with. So how much in dollar terms are you about to have to pay out for this thing? The denominator is what we call the cost object. So it's how this is being applied. So are you assigning cost on the basis of labor hours, on the basis of labor dollars? Are you using machine hours? What are you using to allocate this cost out? And so here's the formula. This is the one you really need. The numerator, estimated annual overhead costs. And I would recommend that at this point, you put to yourself a reminder, this is right here is in dollars. And this is in some type of unit. So that means the thing that you're getting is $1 per something. So I'm going to say per unit, but of course this could be per hour. This could be, in the case of us using direct labor dollars, this could be per dollar, right? But generally it'll be per something, right? So you have dollars on top and you'll have something else on bottom. And I always recommend in this class, it is very, very, very important for you to keep track of those labels. If you lose track of those labels, you start to make silly mistakes. And then when you come into my office, we have a big laugh about it because I go, come on, what is this units per dollar thing that you gave me? It doesn't make any sense. That's not how this would work. And so while people sometimes think it's a waste of time to write down those labels, if you do, it will prevent you from making a silly mistake. So don't make that mistake. Write down the labels. But this is, in my opinion, at least the second most important formula, maybe tied for the first most important formula for the entire semester. So estimated annual overhead cost divided by estimated annual operating activity. Now, something else you need to notice, this is at the beginning of the year. So I'm doing this at the beginning of the year. Do you know exactly how many hours your employees are going to work in January? On January 1st, do you know exactly how many hours your employees are going to work over the course of the year? Exactly, to the hour, to the minute, do you know? Probably not, and that's okay. This is an estimate, right? This happens at the beginning, so this is an estimate on the bottom, and it is an estimate on the top. This is important because as we move through the course, the questions will begin to start including things like actual hours worked or actual costs incurred. But when I'm determining the predetermined overhead rate, notice this is predetermined. The prefix pre, of course, means before. And so we're doing this before we know what happens exactly. So I have to be really careful that I don't overdo it, right? And I don't start pulling in actuals too early. So in the first step, I have to calculate this predetermined overhead rate, meaning before. So it's all estimates. Estimated annual overhead cost, estimated annual operating activity. Now, in the second step, when I have to actually apply that, then I'll multiply by actual usage. So let's see. So notice here, they tell us the first step right here, calculate a predetermined overhead rate. I don't know why they put them in this order. And the second order, the second step, we multiply by the actual activity-based use. So this happens at the end of the period, at the end of the month, at the end of the year. And in this case, this will give us my applied overhead. So applied overhead is my predetermined overhead rate, which we calculated on the last slide, multiplied by my actual activity. So students get very confused here sometimes because they forget the first step is predetermined. So it is all estimates. But to get the actual number that goes to work in process inventory as applied overhead, that is multiplied. Your predetermined overhead rate is multiplied by the actual activity-based use. So the actual comes in the second step. The first step is all estimates. And this will take some getting used to, and we'll work through some examples, and you'll be fine. But do be careful that you remember the first step, all estimates. Second step, that rate that you get in step 1 times the actual amount of activity used. So that's how this works. Here we go. Wallace Company uses direct labor cost as the activity base. Assuming the company expects annual overhead to be 280 and direct labor costs for the year to be 350, they want you to compute the overhead rate. So you can see here the estimated annual overhead cost is 280. The estimated direct labor cost is 350. You divide that, you get 4/5, which is 80%. And so that's your overhead rate. That means for every job, for every dollar of direct labor, we will assign 80 cents of manufacturing overhead to that job. So now they say, well, calculate the amount of overhead, assuming direct labor costs were 28. Well, you just figured out it was 80%. So you'll take 28,000 times 0.8 or times 80% or 0.8 in the calculator, and you'll get $22,400. Here's the entry. Debit to work in process inventory going up. That's an inventory account. It's an asset. And credit to manufacturing overhead. But notice here, it's a credit to overhead. This is applied overhead. This is not actual. This is applied. It's our best guess as to what we're going to incur for overhead. So that's how that goes. And you'll notice that that applied amount is what's actually being moved into the work in process inventory T account. And you can start to kind of understand why it might be a problem at the end of the period if I don't nail this estimate on the head. If I get off on that estimate from what actually happened, then you can see that my work in process inventory T account will be misstated, either too high or too low. And if my work in process inventory account is misstated, right, it has the incorrect amount due to an improper allocation of overhead, then when my inventory is completed, the incorrect amount will move from work in process to finished goods inventory. And if I have the wrong amount there, then when I sell it, the wrong amount will move through to cost of goods sold. And so I have to, at some point, come back and correct that. And that's what we'll do toward the end of this chapter, is look at how we deal with situations where, like in this example, we have a remaining balance here, meaning what actually happened. So this is actual overhead on the left, and applied overhead, what's over here on the right, aren't the same. We'll deal with correcting that issue at the end of this chapter. So do keep that in mind and kind of understand that's why it's important, because it will fundamentally mess up my balance sheet in the short term, right? As this thing stays on the balance sheet. And then once I sell this thing, it will actually mess up my income statement because it will mess up my cost of goods sold number. So you can see here, this entry reduces the balance in manufacturing overhead and increases the work in process inventory account by $22,400. So here's a decent illustration of this. So you can see here, we've got some manufacturing overhead for job 101. We've got some manufacturing overhead for job 102 and for job 103. So that's the 19,200 plus 3,200 is 22,400. And so that's where that 22,400 is coming from. Okay. At the end of each month, the balance in work in process should equal the sum of the costs shown on the job cost sheets. And so that's what we saw just a moment ago. Now, in this case, they tell us Stanley Company produces specialized safety devices. For the year, manufacturing overhead costs are estimated to be $160,000. Estimated machine usage is 40,000 hours, and the company assigns overhead based on machine hours. So based on hours in this case, they tell us job number 302 uses 2,000 machine hours, and they want us to compute the predetermined overhead rate. So remember, the formula is the estimated annual cost divided by the estimated annual usage. So in this case, you have to be really careful. A common mistake I see students make here is they do fine on that $160,000, but then they divide by 2,000 machine hours. And in this case, yeah, I think you would get something like $80 per machine hour. And then they'll come down and they'll say, okay, well, I need to take my $80 per machine hour, and I need to multiply that by my 2,000 machine hours used, and I get $160,000. And they think that's right. But do you see the problem? You just assigned an entire year's worth of overhead to a single month, to a single job. Well, that's not right. And so the point here, I want you to be very careful because this is wrong. Do not do this. Be very careful. What you need to do is what they do here, which is take the annual amount, so the annual estimated cost, divided by the annual estimated usage. And that's the first step. That's step one. And so at that point, that's what we have right here on this slide. The next step will be to take the predetermined overhead rate, the predetermined overhead rate times actual usage. And I want to be really clear here. This is actual usage, not an estimate anymore. When I'm making the application, I need the actual number. And so that's where we're going to be very careful. So now we'll take the $4 per machine hour times 2,000 machine hours, and we'll get $8,000. Okay. And so that's what we'll see right here on this slide. So those are the two steps. It never really gets a lot more complicated than that. That's kind of it. That's what we're going to be doing here. Now, sometimes I might give you a different piece of information, or I might give you, the direct materials cost and the direct labor cost and the total manufacturing cost and ask you, for overhead, or, I can move things around a little bit, but this is the foundation. This is how this works fundamentally. If you understand this question well, then it puts you in a really good position to get all of the questions on overhead right for the remainder of the semester. So do keep that in mind and do try to pay very close attention to this problem, because you will certainly have at least one, likely more than one problem, both computing overhead, maybe doing the journal entries related to overhead, correcting the overhead account at the end of the period, all of that stuff for sure on exam one. And likely in spades, as they say, right? Likely in a large quantity of those types of questions. So do really key in on this section of the video and make sure you understand how this works, because it's not only going to help you on exam one, it will help you on exam 2, on exam 3, and on the final exam. It will be there on every exam in one way or another, guaranteed. Very, very important information being covered right here. Okay. Next. They tell us Stanley Company has this information. This is the same thing we just did. They want us to prepare the entry to apply the overhead. And so once again, they'll debit to work in process inventory, and he'll credit manufacturing overhead applied. And so in this case, that's what you see here. Next, we want to prepare the entries for manufacturing and service jobs. Once again, this class is primarily about manufacturing, right? That's why that's generally what we focus on. So I'm not going to spend a ton of time on these, but we'll kind of get through them to some degree. So in this case, they tell us when a job is completed, we want to summarize the cost and complete the lower portion of the cost sheet. So they show us here, we got direct materials, we got direct labor and overhead, coming out to a total of $39,000. And we've got 1,000 units. So that's the price of $39 per unit. You'll notice what happens in this journal entry is we're reducing work in process inventory. So this work in process inventory is an asset. It's going down, so that's with the credit, and it's going to finished goods inventory, which is also an asset. So it's going up with a debit. So the journal entry here is a debit to finished goods inventory and a credit to work in process inventory. Now, like I recommended earlier, especially if you're a little bit rusty with your journal entries, go ahead, draw yourself some arrows here to remind yourself what is happening to that account balance when you're doing these entries. So here you're telling the story that finished goods inventory went up and work in process inventory went down. And so then you need to ask yourself, well, is that the story I'm wanting to tell? Often, once again, students will write journal entries that when I tell them the story behind what they wrote, they just laugh because they can't believe they wrote something so absurd. But in this case, this is a good entry. We're telling the story of inventory that was being created that is now finished. And so work in process should go down and finished goods inventory should go up. So do get used to doing that, and it will help keep you clear of any silly mistakes. Okay, next we see Wallace Company selling on account job number 101. The job cost 39 and it sold for 50. So if you remember back in financial accounting, you learned that anytime there's a sale, there's not one journal entry, there's two journal entries. And so the first journal entry, or one of the journal entries, records the cost of the sale. this is what it cost the company. This is the cost of goods sold entry. And one journal entry records the revenue, right? So the how much did we get journal entry? Now, I will generally tell you, I think it is best to record the cost entry first, though they should be recorded basically simultaneously in practice, because I think it would make more sense for a mistake to occur where I might forget to record the cost because maybe I don't want to do that, but I'm always going to want to record revenue. So I generally recommend that you record the cost entry first and then record the revenue entry after. But in practice, they're going to happen basically one after the other, right? They should be boom, boom, or maybe simultaneously. If you're using some type of accounting software, it may do it for you. So this is the setup. So we need 2 entries here. And so you can see the way the book did it, they did it opposite of what I recommend. It doesn't matter. It's the same 2 entries. But my personal preference is generally to record the cost first. But in this case, we'll see how they do it. So first journal entry, increase to accounts receivable. So this is an asset, it's going up. And an increase to sales revenue. That's a revenue account, it's going up. Next, we have a debit to cost of goods sold. That is an expense account, it is going up. And a credit to finished goods inventory, which is an asset account, so it is going down. Now, if you're struggling with normal balances, this is the acronym I have always used, which is DEAD, CLOR. So DEAD, meaning debits are expenses, assets, and dividends. And the CLOR is credits are liabilities, owners, equity, and revenues. And so this is the acronym I have always used. I know LSU often uses something about elephants driving little red cars. That's fine if that's the acronym you prefer. It's not the one I'm most familiar with. So this is the one I have always taught, which is DEDCLOR. So debits are expenses, assets, and dividends, and credits are liabilities, owners, equity, and revenues. Whichever one works for you is fine. Or if you just have a list memorized, that's fine too. But you need some way to make sure you generally know what the normal balances of things are so that you can understand when they're going up, what you do, when they're going down, what do you need to do. Okay, that's finished. We'll go ahead and we'll move on. So here we see kind of a flow chart of how this all works. Illustration 215, very, very helpful if you're a visual learner for how this stuff works. You'll notice the raw materials, the factory labor, and the manufacturing overhead are all going to work in process inventory. And then, of course, when finished, the work in process inventory moves to finished goods. And then when sold, that will move to cost of goods sold. You can look at this graphic very quickly and kind of get an idea for how things work. But if you're struggling at this point in the text, I think this is a good graphic for you to spend maybe 10 or 15 minutes on, really familiarizing yourself with where the errors are coming from, where they're going to, and then walking yourself through the logic for why that's working in that way so that you don't get confused later. Okay. So here we see the flow of documents. Once again, this is something that I am not overly concerned with, are the actual flows of the documents, like, you know, a materials requisition slip eventually goes to the job cost sheet, that's true, or what's the labor time ticket. I'm not going to test you extensively on those terminology type things from this slide. The most important thing from this slide, once again, is going to be overhead. Overhead is always kind of the thing that we care the most about because it's the most complicated. I can tell pretty easily, well, how much lumber did I use? How much time did Jimmy spend, you know, welding this thing? Those are all pretty straightforward. What's less straightforward is, well, how much electricity should I assign to this job versus that job, right? Well, that's kind of tough. Or how much should the property taxes go toward this job versus that job versus these 18 other jobs? Well, those things start to get a little more complicated because they're a little more abstract. And so we have to find a way to do those allocations appropriately. And we find that's generally a little bit more tricky, a little bit more difficult. And so that's why we spend so much of the semester looking at overhead, because that's the sticking point, both in here and in practice for a lot of different things. So this is kind of the other side of this chapter, which is service companies. Service companies won't have inventory. So can you imagine if you went to the barber shop? So a barber shop's a service company, and you said, yes, I would like that haircut on the shelf. and they handed it to you, and magically your hair transformed into that hair. Now, to some extent, this is a thing if you have, say, a wig, or if you're, going wig shopping, well, you could do that. But if I'm going to a physical place for them to cut my real hair, it's a little different, right? They have to physically do the thing. Similarly, in accounting, we work a lot of hours, January through April, and then again September through October, as extension season rolls through, and then right at the end of the year in December. So there's times of the year where accountants work incredibly long hours. We might work 80, 90 to 100 hours a week. If we're doing that, well, it might be nice later in the year for me to say, well, I just banked 40 or 50 hours on the shelf, and I'm going to take off, the next X number of weeks, because each week I banked those hours, and now I don't have to come in because my job's on autopilot for the 2 months I take off. Well, it doesn't work that way, unfortunately. There's not an inventory of hours, right? The work has to be done when it comes in. I can't pre-do work that doesn't exist. And so we see that for certain companies, they don't have inventory. It can't be stored in the way that it can for someone like Walmart, or another company that's selling actual product. Service companies don't have that ability, and so they don't have inventory in the same way. And so the costing works a little bit differently. Here's where the big costs tend to be things like labor, or depreciation, or some type of software allocation. So some of the softwares the big four accounting firms, for example, use maybe cost many, many, many millions of dollars a year. And this is particularly true now with the integration of a lot of AI. I just went to a bunch of presentations just this last week where KPMG was talking about a lot of the really cool stuff they're doing with AI to help automate some of the more manual tasks that first year accountants are doing, so that they get the accountants coming in really thinking more critically about the real accounting issues they're facing, and doing less just manual grunt work. For example, things like building a flow chart that used to maybe take a full day or two can now be done in just a couple minutes, and then just be edited, so that you're thinking more deeply about the overall picture, and less about, how do I move this arrow, or how do I do this thing? And so these companies are developing these softwares and these systems that are really complicated and really complex, and cost a lot of money, but then that cost can be allocated to their various engagements to help recoup that cost, to help them, make the next big innovation or the next big thing. And so accounting, like every other industry, has to kind of keep up with where the current world is, what the environment is. And so the big four are making those strides very quickly, to really get people being less of just we'll say a data cog, and more kind of involved in the thinking, and the figuring out, and the advice giving. That's why the advisory positions at these big four accounting firms, for example, are becoming more and more frequently available, is because they're growing those practices at a lot of these firms. And so this is something you want to kind of keep track of, and kind of think of if this is something you're interested in. And so this is the setup. So part two, there's a couple of different ways that they can do costing here. First is what's called cost plus. So this is somewhat rare, which is just I get to decide that I'm going to make a 20% profit, and then whatever my cost is, I just charge you 20% more than that, and that's what you pay. That's generally going to be a tough sell, because from the customer's perspective, there's no incentive for you as a worker to be efficient, because you'll just pay 20% or 30% or whatever the percentage is that you've determined, more than whatever they tell you the cost was. So a lot of times that doesn't work very well. So there's another option, which is called like fixed contract pricing. So the customer agrees to some set amount, and then if you can do the work for less than that, great, you make some money. And if you can do the work for more than that, then it kind of stinks for you, because you messed up the bid, but you're still kind of bound to that bid. And so the customer gets a deal, and you have an incentive next time to either up the bid on the front end and tell the customer why, or improve your efficiency so that you're able to actually make money on that job maybe the next time. So here we see Durham Decor is an interior design company. The entry to record the assignment of $9,000 of supplies to projects, where $7,000 is direct and $2,000 is indirect, is given below. So you can see here we don't have work in process inventory anymore, because there's no inventory. So in this case, it's called service contracts in progress. It's just a kind of a record keeping account that we know where things are. And then here, instead of manufacturing overhead, this is called operating overhead, but it works very similarly to the manufacturing overhead account. And then of course, a credit to supplies. Similarly, for the payroll, we see a debit to service contracts in process, a debit to operating overhead, and then a credit to payroll liabilities. So all this stuff over service companies, not going to be heavily tested. You might get a question about it, but the good news is once you know how the accounting for the manufacturing companies works, you know how the accounting for the service companies works. You can see that we're doing really is plugging in operating overhead where we used to use manufacturing overhead, and we're plugging in service contracts in process where we used to use work in process inventory. And so the accounting is very similar. And so you shouldn't really need to spend too much time here on these types of things. Learn the manufacturing side really, really well. And then if you get a question about the operating stuff, you just switch out the terminology a little bit and move on. Okay. So in this case, they tell us Dorm Decor is an interior design company. They apply overhead at a rate of 50% of direct labor cost. The entry to record the application of overhead based on $84,000 for direct labor is going to be 84,000 times 50%, which is a predetermined overhead rate. And then, of course, you see the entry: a debit to service contracts in process, a credit to applied operating overhead. Next, they tell us upon completion of a design project for State University, the job cost sheet shows a total of 34. So here they're going to debit cost of completed service contracts, so similar to finished goods inventory, and a credit to service contracts in process, similar to work in process inventory. So a couple of things here, just kind of wide arcing or kind of overarching. There are some advantages to using job order costing. You get very precise assignment of costs, and you have potentially more useful information. But you can tell there's a lot of stuff that happens here and a lot of record keeping that would not be necessary if I used process costing instead. So if you're on the bubble and you think, well, this should be using job order, this should be using process costing, in practice, you might decide to go to process costing because the data entry requirements, the data analytics requirements are maybe a little bit lesser. And so that's something to consider. And here it's always going to be pretty cut and dried if something should be using job order or process costing. And so you'll kind of know. But in practice, no one's going to tell you how you should be costing things if you start your own company. If you go to an established company, sure, there are work papers from prior years that you can look at and things. But ultimately, you need to be able to make these decisions. And so that's kind of what this class is all about, is putting you in a position to make these kinds of decisions for yourself, and so that you're able to do that. Okay. Here they have a sale. And so they tell us during the current month, we completed jobs 109 and 112. Job 109 had a cost of 19. Job 112 had a cost of 27. And job 112 was sold on account for 42. Now, this is a great question. I really, really like this question. And I'm not going to guarantee there's something like this on your exam, but I am going to tell you there is a very high likelihood something like this could be on your exam, because it gives you multiple jobs and it puts them at different places in the process. And then it asks you to kind of keep track of all of that information and then make decisions. So figuring out, is this thing still in finished goods? Is it still in work in process? Is it sold? Is it being counted as revenue or cost of goods sold, or where are the things at in all of this? And so this one's kind of nice because you really only have stuff in two places. It's either in accounts, it's either in finished goods inventory, or it's sold in this case. If I were going to make this a test question, I might actually expand it and have inventory at the end in all three places, or even in all four places, and have stuff, some of it in work in process, some of it in raw materials, some of it in finished goods, some of it in cost of goods sold and revenue, et cetera. And we could really get this thing cool. But this one does a good job because they tell us, well, you finished these two jobs and they had a cost, in this case, of 19 and 27. So that's the first journal entry right here. 19 plus 27 is 46,000. Job 112 was sold for 42. And so you can see that's where the 42 is coming in. But remember, this only sold 112. So we can only take the cost of job 112, 27,000, not the full 46, because we have not sold job 109 yet. And so you do have to be very careful. But as long as you do this in a step-by-step manner and you take your time, then you should not run into any difficulty here. It's just a matter of staying organized. It's not, necessarily difficult. It follows the same journal entries you would have learned in financial roughly. but it is a matter of being organized enough to keep track of where things are in the process. And that's where we can have some difficulty sometimes. And then finally, we want to look at dealing with over and under applied overhead. And so here's a good illustration. So we see here we've got direct materials used 24, direct labor 28, and applied overhead of 22.4, giving us total manufacturing costs of 74,400. So remember, when we talked about manufacturing costs originally, we said that's direct materials plus direct labor plus applied manufacturing overhead. And we see that coming through here on my cost of goods manufactured schedule that y'all should have prepared in the last class when Ms. Morgan substituted for me. And then that'll give us a total cost of work in process. We'll back out whatever is still in work in process, and that will tell me what is manufactured. That is the stuff that is finished. And so we see that here. Now, this is where we want to talk a little bit more about what we talked about earlier. A debit balance in manufacturing overhead means overhead is under applied because actual exceeded applied. So you didn't apply enough. So what's the solution? Apply more. And if a credit balance appears in manufacturing overhead, then that overhead is over applied. And so we want to see how we actually correct this. So here's kind of the rule for what happens. If applied is less than actual, manufacturing is under applied. Applied is greater than actual, then manufacturing overhead is over applied. So once again, this is the T account you want to memorize and have it tattooed so that you never forget it, right? This is the stuff that's going to keep you straight in this class is that T account. If you understand that T account and you really understand it and really everything that it's telling you, then you'll be okay with these types of entries and with these types of situations. And if you don't, it is very easy to mess them up. So do be careful. But because we lack a crystal ball, like we talked about earlier, right, where we say, well, at the beginning of the year, I don't know exactly how many hours I'm going to use or exactly how much dollars I'm going to spend on my overhead, then it's very likely at the end of the period, the amount on the left-hand side, my actual overhead amount, so this is manufacturing overhead, my actual amount is not going to be equal to the applied amount. That is almost always going to be the case. And as we talked about earlier, that amount that's in manufacturing overhead that gets applied eventually gets sent to work in process and then to finished goods and then to cost of goods sold when the thing is sold, which means we're misstating our inventory for a while and we're misstating our expenses. And so, of course, we can't just let that go by without being corrected. And so now we need to look at the correcting journal entries for how this is going to work. So I'm going to erase that. And they tell us we have a $1,400 debit balance in manufacturing overhead. So remember, once again, this is actual and this is applied. So if I actually incurred more overhead than I've applied, then right now my inventory balance is understated. And if my inventory balance is understated and I sold this thing, then my cost of goods sold balance is understated. So what I need to do is actually increase my cost of goods sold amount so that it is now properly stated and apply more overhead. So in this case, I will debit cost of goods sold, which will push it up, and I will credit manufacturing overhead for $1,400. What this will now do to my T account is do this to it, where now it has a zero balance because my overhead account is not what we would traditionally think of as a real account. It is what we call a suspense account, meaning it's only used during the period, but it does not appear on my balance sheet. It does not appear on my income statement, my statement of retained earnings, my statement of cash flows. It's not a true real account that anyone outside the company will ever see. It's only used during the period to help me allocate costs. And then at the end of the period, it goes away down to zero. It gets closed out completely because it's not going to be popping up on anything like a real balance sheet, for example, or an income statement. So it always has to go to zero. So when you're trying to deal with this correction at the end of the period, just remember that the goal here is to get the overhead account down to zero. So if you have a debit, then you must credit overhead. If you have a credit, then you must debit overhead. And then the plug account, the other account, is cost of goods sold because that's how you're going to balance out that journal entry. And so that gets you through that. You can see here, they've got their income statement And so they do actually show in this case the adjustment for under applied overhead. That's fine. Traditionally, you won't really see this on a real income statement. Um, there might be a footnote in the financials. I kind of even doubt that. About this is maybe a little too granular for if I were publishing this externally, but here they're just kind of showing you what's happening. And so you see they had under applied overhead. They needed to apply more. That increased the cost of goods sold, which pulls down the gross profit. And so that's effectively how this all works. So in this case, they tell us we've got a company, we've got a predetermined overhead rate, 140%. So they already did step one for us. During the month, we incurred 90,000 of labor, of which 80,000 is direct and 10,000 is indirect. Now, this is a situation where you need to be really careful when you read the predetermined overhead rate. Notice what they tell you. The predetermined overhead rate is, and in this case, they say 140% of direct labor. Now, in this case, that means the only portion we care about when we're dealing with this application is the direct portion. Now, it could be that the question says it's 140% of labor costs. If it is, then it would be the 90,000. But in this case, they specifically tell us this is of direct labor. So that's the only piece I can use. And that's why here we can only use the 80,000, not the 90,000. So do be careful there. A lot of students get in a hurry and they rush through this and they mess it up. Alternatively, they tell us actual overhead was 119, compute the amount of manufacturing overhead that was applied, determine the over applied or under applied. So they told us actual was 119, applied was 112. So we did not apply enough. We are under applied. And so in that case, we would do the exact same entry we had on the last slide to correct, where we would simply debit cost of goods sold to increase that, and we would credit the manufacturing overhead applied account to apply more. And so that's how that would go. So with that, I'm going to wrap up the discussion on chapter 2. I'll post the handouts and let me know if you have any questions. Thank you so much.